I'd like to give you an opportunity to tell us a bit more about yourselves and what your organizations are doing in the region. So, Suresh, you can start with you.
Sure. I'm with the Overseas Private Investment Corporation, which is the U.S. government's development finance institution. We're a large supporter of projects across the globe. We're providing direct long-term debt and guarantees to projects, providing political risk insurance to help investors from abroad offset perceived and real potential risk in market. And we support private equity funds, but at the fund level, so we don't do any direct equity. Globally, we have about a $22 billion portfolio. About $6 billion of that is here in sub-Saharan Africa. I sit in Nairobi, having moved to Kenya about a year ago to open up our East Africa office. And so we're very active in East Africa. We have about $1 billion in our portfolio. It's highly concentrated in Kenya right now, but we'd like to diversify that as well. And it's across sectors, so energy, real estate, infrastructure, financial services, education, healthcare, and more. So fairly diversified there.
Godfrey.
Godfrey Tapela. I work for IFC. IFC is the private sector arm of the World Bank, so we're basically owned by member countries. But it does mean that we provide concessional funding. I think there's always a misconception that we provide concessional funding, but we are the private sector arm of the World Bank. Basically, I mean, the World Bank was formed, the old acronym is IBRD, International Bank of Reconstruction and Development, to rebuild Europe after the World War. Then there was a realization that you need an entity to work purely with the private sector. Hence, our mandate is really to support private sector companies in emerging markets and providing funding right across from debt to equity and in between on projects that provide development impact. And I think in Africa, for example, I mean, we've grown our portfolio in terms of business. I mean, when you look at it, I think in the 90s or the early 2000s, our program for Africa was maybe something like, doing $140 million a year was a big achievement. To date, we are in between, 3.5 to 4 billion a year in terms of commitments, but that is across a wide variety of sectors. My specific focus is on tourism, commercial property, housing, and retail.
Okay, Damien.
Good afternoon. I'm Damien from Proparco. As you may know, Proparco is a French development bank. Fairly active in Africa because we do half of our business in Africa. Last year we committed 1.3 billion across the world. We are fairly active in the hospitality business space so far, closing 3-4 transactions a year in Africa in this space. I'm covering the East African region. And for us, the tourism is the key sector as a development bank, and financing either some international brand willing to expand in Africa or some regional player like we've done for Serena in East Africa or Azala in West Africa.
Good afternoon. My name is Samuel Githinji, running the Danish DFI in East Africa. We are very sector focused, as you can imagine, on hospitality, specifically hotels. We have done historically close to 60 hotels, city hotels, lodges, and it's still a focus sector going forward where we feel there's a lot of development impact, a lot of foreign currency inflows, and all these kind of things that fit into the DFI model. But generally, we're also very strong in other sectors of the economy. Probably one of the older DFIs ourselves, 50 years now we're celebrating. And 1,200 investments over the years, so we have a fairly strong understanding of how the developing countries work, and East Africa specifically, where I sit.
Okay. So, Damien, let's begin the conversation with you. Why DFIs as opposed to your traditional commercial banks?
Why, sorry?
Why DFIs? Why should we come to you as opposed to the commercial bank?
For a couple of reasons. I would say the first of all is, of course, the financial proposal that we can propose to international brand, regional player, along with local promoters, meaning that we can provide really long-term financing, which in some countries is not really available. So giving time for the promoters and the brand to go through the business plan and having time for the ramp up. I think what is key as well, maybe from international brand perspective, is the local presence that we have on the ground. We know quite well some promoters. We know the environment, and sometimes it's quite important for them to know who is reliable, trusted, and strong enough in terms of financial capacity.
Okay. Godfrey, what criteria do you look for in projects and you do grant them funding?
The last part of the question, I didn't get that.
In terms of both the project and the partners, what are you looking at?
Okay. I think just to put things in perspective, my colleague just alluded to the role that DFIs play, and we would typically, go into those markets which are quite difficult to operate in, and provide the long-term funding that is not necessarily available. But from what we look for basically, I think is the standard criteria that maybe a commercial bank would look at, and go beyond that in terms of what ticks the boxes in terms of development impact. I mean, for starters, I mean, it's important for us to be comfortable with the partner that we're getting into a business relationship with. So it's really a KYC aspect. I mean, that's our starting point. We have to be comfortable that there's somebody that we can do business with. I mean, integrity is important, and obviously I also look at their capacity in terms of do they understand that industry. I think the hotel sector is unique in that obviously where the sponsor might not necessarily be a hotelier, you have the operators to bring that skill set to the table. So we're happy to work with sponsors in that regard. But the project on its own has to be commercially sustainable. For it to deliver development impact, there's no use just going after a project because it's got social benefits if it's not going to be profitable, because it's not going to be sustainable. You may as well not do it from that perspective. But from a process perspective, obviously, I mean, we look at underserved markets. Is there a supply-demand gap in that particular market? Is the project, does the project stack up financially from a cost perspective? I mean, you build for a market, you don't build it because they will come. So the costs have to, be aligned with what you can, realize from, the room rates that you need to charge on the hotel. But basically also look at, the tenors, because as was mentioned yesterday, a lot of these hotels, I mean, or typically any project runs into delays, cost overruns. So the tenor has to accommodate that. And you also need the financial capacity to ensure that the sponsor can stand behind the project, ensure that this is finished. I mean, an incomplete hotel project is no use to all the stakeholders. So it is from that perspective that, we ensure that we address, everything is addressed, and the feasibility studies, etc.
So Suresh, just to pick up on Godfrey's points, how do I structure my assets in order to meet your investment profile?
How do you
structure the assets?
How do you structure it? I think the structure itself can be fairly straightforward. I think one of the things we're looking for, is really cleaning up what Godfrey just said. Where we've really struggled on projects in this sector is where our partners, the sponsors on it, do not necessarily have the deep track record and the financial capacity to kind of execute on this, right? So we as debt providers want to build in a structure that's flexible and that has enough tenor in it and grace period in it to allow for things to go wrong at times, and we can be flexible. But at the end of the day, we need partners who are really the ones on the ground executing on this to be able to complete a project and then operate it. And so we're looking for strong partners, right? So which is often there's a trade-off when you're looking at projects in the secondary markets, the other periphery markets, where you don't necessarily have people who have done this 3, 4, 5 times before, right? They're doing this for the first time. But we are looking for them to be able to demonstrate their financial capacity, their ability to execute, their understanding of the market, and maybe it is bringing in good partners. We do certainly look when they don't have that experience for them to be bringing in good management companies to do it, to bring in good construction companies to execute at cost, and then to the extent it's needed, providing the financial support should there be cost overruns to the point where it wasn't conceived to start with, to be able to step up and complete the project.
Okay. Samuel, now Godfrey mentioned some point on the social economic effect. Now I notice your organization does have a bias on ensuring that the development projects that you take on have that social economic effect. Now looking at this from the hospitality industry, how do I get the hotels to have that effect?
I think when you make hotel investments, it's intrinsic. It's inside already in a hotel investment. Number one, because of the key sectors we look at: employment creation, foreign currency inflows. So hotels intrinsically, without working too hard, it's already inside the investment. So it ticks off all the boxes automatically. But when you look at the social impact, we also look at it, we choose to look at it at a holistic level, even the sustainability, the governance also of the project. So we as a DFI, we say as the Danish DFI, we prefer the equity play as opposed to the other DFIs who prefer the debt play. And when in the equity play, then now we're able to implement those other social aspects of the project. And for instance, one of our projects where we have some green energy funding, we are able now to say install solar panels, solar water heating panels, and power and reuse water. So all these things are installed inside the project.
Okay. So Damien, you have someone who's interested in putting up a hotel. He's come up with a proposal to your organization. Talk to me about fine-tuning the budgets to ensure that I do not miss out on the opportunity just because my projections weren't right. And what guidance would you give, or what should I be looking at to ensure that the numbers are gotten correct from the onset?
That's part of, I think, what DFI can bring in the table is, we're not specialists, but at least we know the tourism sector, and giving them either advice or bringing advisor into the table, which could help them to fine-tune the business plan, not underestimating the cost, the budget, which sometimes happens in some projects, bringing them as well in the table, constructors, third parties, which could help them to get the right project and in time.
Okay. Godfrey, in terms of reforms, what should be done to ensure that in this sector we're seeing more private investors being encouraged to bring money?
I think at a regulatory level, I mean, you obviously need an environment that encourages private sector investment. I mean, in certain instances, there will be incentives for specific, sectors to ensure that, you attract investors in that regard. I mean, for example, there's elements to do with, how active is the government in terms of, marketing the country as a destination. I think that talks to not only an interplay between, talks to an interplay between the private sector and the government. So the government has a role to play, but they have to create the necessary regulatory framework, which is investor friendly to attract, tourism players. Because typically, it's not just about local players, but you also, look to involve international, stakeholders. Operators, for example. I think we mentioned that it is important to have them in projects. It's not necessarily that, we would finance only projects where international operators are involved, but there should be a level playing field. You'd find there are situations in certain markets where the government is a player in the tourism sector, and how do you then create an environment where the private sector can compete on an equal footing rather than having a skewed landscape? I think, there's a broad aspect that one can look at in terms of regulatory reform. I think it's not just one aspect, there's a lot.
Looking back home and what's currently happening, it seems to be something that's quite common in the region, also with Uganda. What do you think is the effect on this, and what could be the solutions into ensuring that investors still are not shying away from such areas?
I'm sure you're talking about the political climate.
Yes, yeah.
I think like any other investor, we take a long-term view of investment, and we are here for the long term. So from a development finance point of view, making more investments, building the private sector is what brings more stability in the region. So DFIs will not shy away from all these countries. I think I can speak for my three colleagues here. We will not shy away from all these things that are happening. We will still invest more, and we'll still put in more. And I always remember 2008, during the post-election violence in Kenya. We were signing a hotel deal in Nairobi, in the streets. There were riots. I was driving through Nairobi, and we were still signing deals. I'm in Uganda next week. I'm still signing deals. I was in Somaliland 4 weeks back, still signing deals. So we appreciate it's there, but that's where we feel our play is more required. So we are not, yes, we are concerned, but it will not stop us from investing.
That's surely a good encouragement.
Yeah.
And for Suresh, having been previously based in the US, what would you give us success stories that can really be adopted in the African market?
That's a good question. I think, we're seeing a lot here. When I started at OPIC in 2010, about 10% of our global portfolio was in sub-Saharan Africa. Today, it stands at 25% of a much bigger portfolio. So we're seeing the markets really open up here, and we're really led by the clients, the investors we support with our products. So we're following them, and we're helping them bridge the gap to invest in these markets, but they're the ones who are interested. So, I agree on this point of a long-term view of Kenya. I think certainly deal flow for us has slowed down over the last few months of the election cycle, but we still are in constant contact with the investors, and they take a long-term view of the market. So I think, as you get the supporting ecosystem, so as infrastructure improves and makes travel to these destinations easier, I think you see the tourism sector pick up. I came for the first time to see the gorillas in Rwanda back in April, and I was amazed at the beautiful roads all the way up through the northern part of the country. I think that all feeds into it. So I think as the countries invest in their infrastructure, as they make a regulatory environment that is more conducive to investment, more certain to the risk profiles in these markets, I think the investment will continue to flow. And I think us as DFIs will be there, to take on the risks that aren't necessarily palatable to international investors or lenders or even the local commercial banks who can't take that long-term view. So I think that the countries here in the region are making, many of them are making the right steps. I think it is a matter of continuing to push forward on the investment environment, on providing capital to the small and medium enterprises and the communities that drive a lot of these businesses and support for these businesses, and investing in their infrastructure and energy, all these things that you really need if you want kind of world-class tourism destinations and business destinations.
Okay. Damien, now, you've put in the capital and comes to the point where the investor needs to exit. How do you manage the process, and what are the options that are available in terms of exiting?
In terms of exit?
Yeah.
Exit is always a tricky question, tricky point that I would say, first of all, we need to spend a bit of time with promoters before entering and really discussing what is the exit horizon, the exit strategy with those promoters. Secondly, as a DFI, we take a long-term view, as my colleague said, so meaning that the exit, we don't mind staying for 7, 8, 9 years in a business, because we take long-term view. We can understand that at some point the business is down for 1 or 2 years because of macro or political reason. And this gives time for the promoters as well to ramp up the business and expand the growth. It's when it comes to exit point, we of course sit down with the promoters and see what is the best option for all of us. We don't force promoters to sell the business because it's not our mandate. We're not PE funds, majority shareholder. So we list different options that we can explore. First one being trying to sell to someone else, willing to take over from us. Second one being liquidity coming from the company, some redeemable shares, so that the liquidity comes from the cash flow from the company. And then at some point, of course, we need to get some exit. So this would need to come from the promoters, and his capability to buy out our shares so that he can carry on the business.
Okay. Again, from the audience, any questions for our powerful panel?
Yeah, what benefit does an investor have in borrowing with a DFI other than from a conventional lender in terms of advantage or disadvantages to an investor?
Okay. Godfrey, you want to take that?
Yeah, I think these advantages, I think some of them have already been alluded to here. We would, for example, be able to provide, we have patient capital, be able to provide, a long-term capital, which might not necessarily be available in the local market. And in comparison, where local currency is available, maybe it's not affordable from, the pricing perspective. But, providing dollar funding for tourism, I think is also, there tends to be a natural hedge. So you find that it tends to be cheaper for the project. But most importantly, I think for us, it's not about the project will make money. Let's bank it. It's about the question that we have to ask ourselves is what is it beyond money that we're providing? For example, we have internal industry expertise. In terms of people that have run hotels before, that have done developments before. So, they are part of the team that does a due diligence on a project. So, effectively, you're speaking the same language with the project promoter, from somebody with a practical perspective. They can smell a project from the interaction or from, the moment that it walks through the door. I mean, so we have that expertise in-house, but you also look at the additional value that we bring to the table is, for example, the environmental and social standards, which is best practice. I think for IFC, I mean, these are adopted globally. And you are trying to ensure that, the building, adheres to best practice internationally. There's no use building coming up with a nice hotel and there's a life and fire and safety risk associated with it. I mean, the next day, if a fire catches up and then, it's all in the papers, the risk, the reputational risk is huge. So we ensure that, that is brought to bear, or our clients benefit from that. The other, aspect that I mentioned, that was mentioned by my colleague earlier is, the green aspect, which addresses climate change. We have all that expertise in-house. So the client has a benefit beyond just getting the money, and it is a partnership. So it's like somebody else with a different pair of eyes looking at your business and tapping into their global experience and bringing it to you as a client.
Okay, our time has run out, but that was a wonderful question to sum up the session. And I think what we take from this is that it is one, a cheaper option, and two, there's the support that you do get in terms of the invaluable experience that you get from the people who come to partner in with you. So, gentlemen, thank you, and I hope that our audience here has gained from the session that we've had.
Thanks, Mbiki.